Okay. In this introductory video, we're going to go through the Annuity and Investment Project, Part 1. This includes two parts. So we are going to be talking about how saving for retirement works. We're going to talk about the math behind it. It's going to be very practical because the sooner you start saving for retirement, the better, right? We're going to see it's related to what we learned about interest. There is a video on this. There is a homework dedicated to annuities as well, but we'll review some of that here. And we're actually going to use a little online calculator that will save us from doing a lot of the math ourselves. So that's a plus. And the other thing we're going to talk about is how stocks work in the stock market. So there are two components to this, both of which will involve some math, right? Let's start with the first component. Let's start talking about how retirement works, right? So I'm going to stray a little bit from the document here just to talk briefly about what goes on when you're saving for retirement and how it's related to the math we did previously. So if you remember when we were learning about how investments work, we have a pot of money, let's say $1,000 that we put in the bank, and that $1,000 accumulates interest over time at a given rate, right? Pretty standard. The thing about retirement that is more confusing is we don't have one big pot of money that we put in all at once, right? So let's say, for instance, that if I look at my paycheck, maybe I don't know how much I earn on a month. Let's say I earn $2,000 a month. I don't even know if that's realistic, but let's say we earn $2,000 a month, and I try to save a small portion of that, say $200 for retirement every single month, right? So month 0, I put in $200, right? And then I do that every single month, right? For maybe, for years, right? Now, each of these little dollar amounts is a single interest problem, right? $200 for, maybe 20 years. Another $200 for 20 years minus 1 month, right? Because it was added a month later. So each of these are going to be earning interest, but they all have different start times. And that makes the math, if we had to do it ourselves, really ugly, right? Now there is a shortcut to this that we cover in class, and we're going to ignore that for the purposes of this project. We're going to use an online calculator that does it for us. It has this Dave Ramsey website that does all that for us. So you don't have to worry about how that math will work out. But this is what I want you to think about when you're thinking about how much you save for retirement and how the math will work, right? The same principles apply. Money that sits longer in the bank earns more money, right? Money that earns a higher interest rate earns more money. And bigger amounts sitting in the bank earn more money, right? So that means if you put more money in the bank earlier, you actually earn more money at the end, right, towards your retirement. So that's why it's so important that you start saving earlier, right? You should start saving for retirement in your 20s because that money is worth more than money you start saving in your 40s or in your 50s, right? That's the idea. Okay, let's read this. Go to the Dave Ramsey SmartVestor calculator and enter your current age and standard retirement age of 65. Enter $0 if you don't have any money currently saved for retirement. Enter how much money you put away for retirement now or how much you plan to put away once you obtain employment. It could be anywhere between $50 to $1,000. For this exercise, use an interest rate of 6%. Report your results in a complete sentence. Be specific in stating the amount of time you invest, the dollar amount that you invest, how much interest your money makes, and the total amount you'll have at the end of the investment. So I'm just going to demonstrate how this calculator works for you. So let's go to the Dave Ramsey website. Oh, dang, I wish it didn't. Let's put this in a new window. That's what I wanted to do. Open a new tab. Okay, let's take a look here. This is going to do all that nasty math for you, right? It'll calculate how many years your investment takes over time. So for me, I'll do me really quick. Let's say I start today investing. I am 33 years old. I'm going to retire when I'm 67. How much money do I have in investments? I don't know. Let's assume I've already saved some money. Let's say I've saved $10,000. right? And let's say that I'm going to contribute $500 every month. And we were told to use a 6% interest rate. Notice this already is in units of percent, so you shouldn't enter it as a decimal. I'm going to say I have a 6% interest rate. Okay. Where does this interest come from? Well, it could be sitting in a bank, but usually retirement accounts are earning more money than your bank account would. It's usually tied to the stock market, right? So you'll invest in some account where they're managing that. It has this note here, right? This is an investment fund, very well known, that tracks the top 500 companies in America, and it is in the 10 to 12% interest range. But we're going to be very cautious and say that we only earn a 6% interest rate. Now, if you hit calculate, it's going to show you some multiple things. Let's take a look at what these outputs look like. Here's the first bit of interest. This is going to show us how your investment grows over time, right? You notice it has a very distinct shape. It has this curved graph. We're earning more money. We're earning money quicker, right? Because we have more money in the bank. That means that money is accumulating more interest over time, right? So in 2024, I start out with 10,000. In 2025, the next year, it's gone from 10,000 to 16,784. Does that sound realistic? Must be 6%. Oh, yeah. Why did this go up so high? I was figuring out. It's because we're earning money from two sources now, right? We're earning the money that we deposit, right? When we deposit money, we get more money. That's not free money. That's money I put in the bank, right? So think about that. If I put $500 into the bank for 12 months, I would have $6,000 additional dollars that I deposited in. But on top of that, I earned interest as well. In this case, I earned $784 additional dollars in interest. So when you're saving for retirement, you have money that you're putting in plus the interest that's accumulating, right? So from two sources. And this shows me that by 2058, my target retirement year, I would have $741,677. Now this actually that sounds a big number, right? Oh my gosh, $700,000. But you have to think, how much money, if I stop working at 67 years old, is that going to be enough money to last until I die, right? Oh my gosh, and now you have to that's math nobody wants to deal with, but you have to think about this in advance, right? You have to think, well, what do I expect my expenses would be, and how long do I plan on living after I retire, right? And you want to have enough money to cover that, right? That's what you want to think about in advance. And honestly, $700,000 is not a lot. It probably wouldn't last me, 20 years. I wouldn't live until 87 with that amount, right? So you do want to think about that. And that's the purpose of thinking about investments in advance, right? So it gives you all of this, these interesting facts, right? It tells you a couple other interesting things. Note this, it tells me that over that period of time, I contributed $204,000, and I earned an additional $528,000 through interest, right? That's quite cool that it does all that math for you. It shows all of those components. And in this assignment, we're going to explore this in different ways. We're going to go beyond that. We're going to play around with the numbers. What happens if I wait 10 years later before I start investing? So you'll want to play with the calculator and change numbers and see what happens. And you're going to see what happens if I start later. Well, you're going to have less money is the takeaway, but you're going to figure out, well, how big of an impact does waiting 10 years make on my final amount, right? That's the goal of that, okay? The next thing you're going to do is you are going to kind of calculate how much money you anticipate needing to survive after you retire, and you're just going to compare that to how much money you actually saved in part A, B, and C, right? So you're going to see, do I have enough money to survive? And this will help you start thinking about how much money you should save for retirement, okay? I'm going to let you do all of that. This one's pretty basic. You're just essentially thinking about how much money you require for all of your bills. I already do this even without thinking about retirement. I do this on a personally, on a monthly basis, I keep track of how much money I spend on food. I keep track of how much money I spend on gas. I don't know if you guys have a good kind of ballpark sense for how much money you spend on these things already. If you commute to school, you're probably going to be spending quite a bit of money on gas, I'm assuming, right? So try to get realistic estimates for these. And of course, they're going to change. You probably have additional expenses that you don't think about right now. Estimating food, for instance, for an individual might be hard if you're used to paying for a family. If you're familiar with your family's expenses. I'm assuming entertainment it's an interesting one. I want you to be realistic, right? You shouldn't set it to zero, right? A lot of people like just to, hey, I'm assuming I'm going to be very frugal and not spend anything on this. You want to think about realistically, right? How much is Netflix and maybe going out on dates? How much are all of those going to add up to in a month's period, right? So think about that. Interesting that they put home costs down for $700. I definitely think that's lowballing it these days. You're going to want to think about how much money you'd be spending on a mortgage or on rent, and that's probably going to be $1,500 plus, not $700 plus, right? I'm assuming $1,500 is lowballing it these days, right? So you're going to want to be realistic in thinking about how much your home costs are on a monthly basis, okay? They have you do some math as well, right? Remember that $750,000 pot of money that I saw in my investment calculator? That has to last me until I die. So assuming I live an additional 20 years after I die, you're going to calculate that. This is going to be how much money you would need to survive for 20 years. And in the end, you want the amount of money you save for retirement to be equal to or greater than that 20-year cost, right? You're going to have to do a little bit of scaling. You're initially going to think about your expenses on a monthly basis. That's usually how we think about them, right? What is my monthly water bill? What's my monthly electricity bill? You may want to actually go look up some statements to get some good estimates for those. You could also Google to see what is an average value in Nevada for some of those things. That might help you get a more accurate number. And then after you have your monthly expenses, you're going to multiply all of those by 12 to get your yearly expenses. After you have your yearly expenses, you'll multiply that by 20 to get the total amount of money you would need to survive after retirement, right? And you're going to use that and compare it to your retirement savings in the Dave Ramsey calculator. Okay? This is a very useful exercise. Everyone should be thinking about this. I hope you take this seriously and put a lot of thought into doing it, because honestly, this is a class assignment, but you should be doing this on your own in real life, right? And this gives you the tools for doing that, right? This is a very practical unit. And this will help you get set up for success in life as you are thinking about what are you going to do after you retire, right? This is meant to be a very practical exercise. Okay, let's go to the stocks unit, right? In addition to money you set aside for retirement, you may decide to set aside additional money beyond that to save for a rainy day, right? Or sometimes I invest money in multiple ways. I invest for retirement through the retirement account provided by my employer. That's kind of what Part A did. But you can also invest additional money that your employer doesn't help you out with, right? And one way of doing that is putting into the stock market. Stock market is a relatively risky investment compared to something like, say, putting it in the bank. But because it's more risky, you can earn more money overall in the end, right? More risky investments tend to have higher payoffs, right? No risk, no reward, right? If you put money in the bank, you might get a guaranteed, 0.5% interest rate or maybe up to 5% interest. But if you invest in the stock market, if you're willing to take that risk, you can earn upwards of 10 to 12% interest rates. And it does fluctuate. The economy does have ups and downs. We've gone through a couple rough patches in the last couple of years. But for the time being, the stock market is performing fairly well. And we're going to get some familiarity with that. We're actually going to pretend we're going to pick some fake stocks, and you're going to see how they do over the next couple months for this course, right? This assignment has 2 parts. And in this assignment, we're going to pick our stocks, and we're going to look at how much they're currently worth. And then over time, over the next couple weeks, we're going to see how much money they accumulate, right? That's the idea. Okay, so the purpose of this project is to provide exposure to the stock market and its basic components. You are going to be given $10,000 to invest in at least 5 stocks. And try to make your investment as close to 10,000 as you can, but do not go over. You will hold these stocks until the end of the semester and report on how well your investments did at the end of the semester. This is going to be a fun little exercise. The good thing about this is, since we're playing a game, we're not investing real money, there is no risk, right? It would be really sad if you invested money and you ended up losing it all, which can happen in reality. It's not quite as risky as gambling per se, but you can lose money in the stock market potentially. Okay, so you're going to go to this website that helps you with stock investments, finance.yahoo.com. It tells you what companies have stock available, and it gives you how much it costs to buy a single unit of stock, right? So what is a stock exactly? It's like owning a small part of a company, right? So if I buy a single unit of stock in Google, it means that I am a partial owner of Google, right? Now I don't get a say in their, if I end up buying 56% of the stocks in Google, I could potentially, I could have control of the company and I could change what decisions they make. But in practicality, small investors like us don't own a majority of stocks in a company, right? So we just get a small, if the company does well, then our stocks go up, and if we sold those at a later date, we could earn more money than we had initially invested, right? That's the idea. Okay, let's see, it gives us some suggestions. Start with looking up companies whose products are a staple in your everyday life. Think of food, technology, internet, retail, utilities, banks. So you could invest in Google, you could invest in Apple, you could invest in Amazon if you're interested in a tech company. Those aren't the only ones that you should considering investing, though. There's a lot of companies out there that do really well that may not be as well known, right? Let's see, stock market is comprised of 11 sectors: energy, materials, industrials, utilities, healthcare, financials, consumer, discretionary. It has all sorts of things you can do. Okay, so let's look at the example they did. Did they have an ice cream company? I think this is a fake company, but let's go look. Let's go look at some. Let's get creative. Let's go to the. Oops, I did the same thing. I need to right click on this and hit open a new tab. Let's find some big name ones. So let's see if we can find Amazon. Here's Amazon. Let's see how Amazon is doing. So a single unit of Amazon stock right now is $169.70, right? Now, the size of that doesn't necessarily mean too much. It's how much it grows over time, right? And you can they have some charts here that tell you how well it's performing. It turns out that Amazon stock has increased by 0.62%, and I think that's actually on a daily basis. So since yesterday, Amazon's stock has increased by 0.63%. And you can see how they do historically. So it has a little chart here. This tells you the value of the stock over time. And this can help you pick good stocks, right? So here's the yearly performance of Amazon. Over the past year, it went from a value of $97 up to $169. So that might be a good clue, right? You can kind of tell, though, if we could predict the future, right, that would be very nice. We could tell how much something's going to increase. Unfortunately, past performance doesn't always tell you how well it's going to perform in the future. If you go to the 5 years, you can actually see that we had a slump here, right? Back in 2021, the economy took a big dip. So if you had invested right here, you would have lost a lot of money over like a 2-year period in Amazon, right? So unfortunately, can't predict the future. Can't tell if there's going to be a pandemic or a depression or something like that in the future, right? You can try looking at some others. It has some interesting ones here. By default, it lists Lyft and Uber. I don't know why those are they're trending right now. Apparently, is Lyft doing really well these days? I don't know. So those companies that notice that Lyft has less value for a single unit of stock. It's only $16, right? 10 times less than Amazon. But that doesn't mean it's a good investment, right? If a Lyft stock went from $16 to $50, that would be better than investing in Amazon stock that went from 160 to 170, right? Because the ratio is a lot greater, right? So you could look at lift over the past year. Has it done pretty well? Well, it looks like it's had a sudden jump. It just recently went up from 12 to 16, and that must be why it's a popular stock these days. It's getting some attention right now. So if you look at that ratio, it increased by 30%, 30% recently. So that's a big increase. Maybe you want to look at some of the hot ones that are listed up here. I don't know what Hood is, by the way. What company is that? Robinhood Markets? I'm not familiar with that company. I think that they are a investment company, though. Like they, Robinhood, I think, is a place where you can invest, like an investment platform. Anyway, you can look up some ones, like you could try looking at, where do you shop for groceries? I don't know. Does Winco have stock? I don't even know. No? I shop at Winco. Smith's one? I don't know. You got to be careful with some of these. Where else might we invest? If we just look at watch lists, this might have a list of stocks that are doing well. You don't have to invest in stocks either, like traditional stocks. You could, for instance, tack your money to the price of gold. I actually do this sometimes. People like to invest in gold because it has, it's worth something. If the economy crashes, gold will always have value, right? So people will always invest in gold just as a safe strategy. So it does fluctuate, of course, but it's a lot more stable, I suppose you could say. The price does go down when the stock market's performing well. Gold doesn't have as much relative value, right? But it is a steady investment you can do in. Another thing you can do is, instead of investing in a single company, which can be risky, you can invest in a pool of companies. This is known as an index fund. What you're essentially doing is you're saying, hey, I'm going to take the average of these companies and my money will be tacked to their average value, right? One very common, there's a couple here, S&P 500, Dow 30, NASDAQ, those are all index funds. And they all take some kind of compound average of multiple companies, right? S&P 500 is a very common one. I'm actually not sure what companies are in it, but you could look it up. Let's see what companies are in the S&P 500. Does it have a, let's look at the Wikipedia article on it. What companies are included in it? That's always something you might be curious in. It has the selection criteria. Does it tell us what companies are included? Here they are, list of S&P 500 companies. Here they are. 3M, I'm not familiar with that company. They're an industrial conglomerate. They got AbbVie, a biotech company. Aflac, I don't know if you remember those duck commercials. They're apparently in here. They're always doing good. Airbnb is on here. You see some other ones. Alphabet, so that's Google. Google's parent company's there. Amgen, I think that's some kind of healthcare company. Semiconductors are a big thing, right? So the components that go into your computers. AT&T, so there's a telephone company. These are all companies that do well. They're considered right now, to be on this list, you have to be one of the top performing companies in the country, right? So you could potentially invest, instead of a single company, you could invest in one of these indexes, right? And you can see how it's doing. Overall, the S&P 500 is doing really well, right? Let's see. How would you invest money in it, though? It doesn't have like a stock price, does it? You're not going to buy $4,900 worth of stock in this company, right? But I think you can find an S&P 500 and S&P 500 index fund. Let's see if we can find the ticker for it. S&P 500 index fund. Let's see if we can find the symbol for it. The annoying thing about this is you have to look up the symbol. You have to know the symbol for it. So it looks like this lists some here for us. This has some names of different funds. Let's try one of these and see if we can find the ticker. FXAIX. Let's see if that's a legitimate ticker here. FXAIX. There we go. This is this stock is one you could buy, right, for $172. It's one unit of stock that's tied to the price of the total value of the S&P 500. So it's not investing in a single company. It's equivalent to investing in multiple companies, right? This is one you could buy. You could potentially invest in this index fund. If you want to find an index fund for a specific market, there are other options than the S&P 500, and they have different inclusion criteria. You could try the Dow. You could try the NASDAQ. I think the NASDAQ is tilted toward tech as opposed to the S&P 500, so NASDAQ has a lot more tech companies. So that's an option if you want to do this. Index funds are traditionally known for being safer than just investing in single companies, right? It's a lot more risky to invest in a single company because that company has a lot more chance of going up or down, right? If you have a set of 500 companies and 10 perform poorly, well, you're not going to lose as much money because you've invested in 490 other companies, right, that are doing well. So you've kind of pooled that risk. So I'll throw that out there. Potentially consider investing in an index fund. And you can Google some of them, Dow index funds, and it will give you the ticker symbol for that company, right? So, yeah. So what you're going to do is you're going to write down the stock ticker symbol that you found. You're going to write down the symbol for it. You're going to write down the number of stocks you'd like to purchase, right? So you remember you want to stay inside the $10,000 limit because that's how much money you have to invest. But I could buy 10 units of stock in this Fidelity Index Fund, right? That would, how much money would I spend? Well, about $1,700, right? So you're going to write down all those numbers. The number of stocks you purchased, the purchase cost per share, and then the total amount is going to be number of stocks purchased times that purchase amount. And then you're going to play around with this until you get, you have to have 5 stocks minimum, and then you're going to total it up to make sure you have below $10,000, okay? And then at the end of the semester, we're going to look up your stocks that you chose during this unit, and we'll see how much money they're worth now, and we'll see how much money you earned overall. Okay? It does have you walk through some rationale for your choice in stocks. What was your rationale for choosing each of them? Right, you could pick individual companies that you're interested in that you think will perform well. That's one, right? Just ones that touch your daily life. You could pick stocks that you looked at their chart, right? You looked at the little graph and you figured, hey, that company seems to be doing really well. I'll pick this company because I think it's doing well, right? Alternatively, you can pick a company that's recently going through a dip. That's actually a good thing because if you buy a company during a dip when it's not doing well, but you know that it's going to be on the rebound, that's a good strategy. Buy in those dips. Buy when things are low, right? That's another rationale for buying a stock. And then finally, you could also invest in an index fund because they have pooled risk, right? Those are all potential things you could put as rationales for buying each of your stocks. Let's see. Okay. It has you do a little thing with the S&P 500, looking at historical rates. And yeah, that should give you enough to fill out your project. Okay. In terms of practical usage, you might consider investing in the stock market. I do, actually. I keep track of how my stocks are doing. I always set aside a little amount of money and put it into an account that I use for investments. It's not a lot, but you can start investing in the stock market with a very small amount of money. You can, if you even just have $100, you can start investing. You have to pick a place to do it. If you want to do it for real, go to fidelity.com as one option. You can set up an account for free, and this is where I do all of my investments. And I'm not an advertising for Fidelity in any way, but the point of this unit is to be practical, and I hope you consider using the things that we learn in this unit in the real world, right? So start thinking about what you're going to do for retirement, and consider using stocks as a way to start earning additional money. So we'll wrap that unit up.